In the world of modern economics, the United States of America has played a pivotal role in shaping everyone's lives. The American dream has fueled the aspirations of tens of millions of people across generations around the entire globe. It has made, broken, and resurrected people. For so long now, it has been the land of the phoenix, the land where people rise from the ashes, natives and immigrants alike. In the last few decades, with the evolution of technology, the world headed into becoming a more interconnected economic unit. Trading volumes in businesses went through the roof and scale became the norm, with, of course, America leading the way. Today, though, there is a huge problem, and we're going to delve into the toxic marriage between the US government and stimulus. Now, for those viewers who are new to this topic, let me explain what stimulus is. It's when the government uses targeted, expansionary monetary or fiscal policy based on Keynesian economic concepts to boost private sector economic activity. The term economic stimulus itself is derived from the biological analogy of stimulus and reaction, with the goal of employing government policy to elicit a response from the private sector economy. During recessions, stimulus is frequently used, lowering interest rates, increasing government expenditure, and quantitative easing, to mention a few, are all common policy strategies used to achieve economic stimulus today. It seems to be coming back, though, under the assumption that stimulus is a good thing. Since 2015, the United States' debt to GDP ratio increased by a monumental 30%. Today, the US is struggling to control inflation of over 8%, but this is the official number. Experts suggest that in reality, America could be dealing with an absolutely monstrous inflation figure of way over 15%. An outrageous figure by any means. Now, I don't mean to be so dramatic, but just for a second, imagine the most powerful country on the planet whitewashing a disaster. So here we are. It's 2022 and the US is in a full-blown debt crisis. Now, a debt crisis occurs when a country borrows excess money and continues to spend it until they reach a point where the borrowed cash becomes a permanent crutch. Soon, lenders realize that the money borrowed by governments has gone beyond the repaying ability of its taxpayer. So now, on one hand, you have a situation where lenders are worried about being paid back and taxpayers are extremely worried about creditors. As a result of sovereign obligation, the government is stuck in an infinite loop of excess spending, which means they need to keep finding new avenues to borrow money to please taxpayers. Now, in a moment, we're going to dive right into how a hegemon found itself stuck in this mud, how bad it really is, and what the future looks like. But first, a quick message from this video's sponsor. Today, investors face a dilemma. Inflation is at its highest level in over 40 years, the Fed is going through a phase of aggressive monetary tightening, and top firms are predicting stock market returns of under 5% for over a decade. Restructuring your portfolio has never been more difficult or more crucial, so where can you turn? Well, I've been advocating for alternatives for a while now, and it seems like everyone else is finally catching up, with even JP Morgan jumping on board. In light of this, new platforms have emerged, giving us access to previously inaccessible assets like fine art, like Masterworks.io. They let you access their exclusive investments from names like Banksy and Monet for a fraction of what billionaires pay to purchase. 2/3 of billionaires allocate between 10 and 30% of their overall portfolio to art, in part to diversify and because it's a natural inflation hedge. It makes sense after all. Contemporary art prices outpaced the S&P 500's total return by 164% from 1995 to 2021, and they've exhibited the lowest correlation to equities of nearly any major asset class. Since 2020, Masterworks has sold 3 paintings, with each returning over 30% net IRR to investors. If you want to get in on it early, all you have to do is go to Masterworks.io, create an account, check out what they have, and invest in their offerings, and my subscribers get to skip their waitlist at the special link in my bio, so make sure to go and check it out. Link as always down below in the description. In late 2020, the US national debt reached a new high of $28 trillion, a number that is cumulatively greater than the US's annual economic output as measured by the gross domestic product. Now, that's not surprising. The last time the debt to GDP ratio was this high was following the recession of 2007-9, post the housing mortgage crisis, and before that, it was in 1946 when the country was recovering from the wounds of battle and was forced to pay for World War II. This fundamental metric is very simple to calculate. It's simply annual national debt divided by its GDP or economic size. This critical ratio indicates a country's ability to meet its payback obligations based on the number of goods or services it has produced or earned. Investors are anxious that the country will be able to pay the bonds and will default on its obligations. Iceland experienced this in 2008, resulting in the country's bankruptcy. Argentina, Russia, and Mexico as well have all been bankrupt due to defaulting on their debt in recent years, while the European Union pulled Greece out of its crisis in 2010 to prevent a worsening of the situation. It has now only repaid a fraction of its debt since then. The worry today is that the US is not only dealing with what happened with the pandemic and the war in Ukraine, but it's also battling crippling inflation due to its sky-high debt. Last year, we saw billionaires all over the world short equities as they saw what was about to come. There's no rocket science here. This is just a bunch of super aware rich folk being one step ahead of the market. They see something which the commoners don't, and believe me, in the market, that makes all the difference. This situation of American debt may seem very recent, but the coffee has been brewing for a really long time, and the current sentiment on Wall Street is that it's going to spill any time now. So let's get back to the roots of it. In 2008, Democrats and Republicans in Congress created a recurring debt crisis by fighting over ways to curb the debt. Democrats blamed the Bush tax cuts for fewer tax receipts as well as the catastrophe on the financial and world markets during the housing crisis. Amid all the chaos, they called for more stimulus spending or tax cuts for consumers. The intention was that the resulting increase in demand would help the economy emerge from its slump and improve GDP and tax collections. To put it another way, the US would do what it did after World War II and grow its way out of the debt dilemma, a solution suggested by Keynesian economic theory. Republicans, who loosely agreed with supply-side economics, aggressively campaigned for more tax cuts for businesses, arguing that the money saved would be invested in growth and as a result, that would create more employment. In reality, both sides had lost their focus on the problem at hand. Instead of concentrating on ongoing economic expansion, they focused on debt. It doesn't make any sense to argue about whether or not Congress should cut taxes or raise spending until the economy is in the expansion period of the business cycle. The most important thing to do back then was to move quickly to restore business and consumer confidence, which would help to power the economy back to normality in a sustainable way. Rather than do this though, both parties compounded the turbulence by squabbling over how much spending should be slashed. They pointlessly debated about cuts to defense and welfare programs like Social Security and Medicare. If government spending is cut during a recession, that reduction will deplete liquidity and result in increased unemployment as a result of government layoffs. Now on paper, when a first world economy grows at a rate of more than 4%, it is typically time to curb spending. To keep the economy from entering the bubble phase of the business cycle and getting back to equilibrium, spending cuts and tax hikes are essential. 2011, though, is when things began to deteriorate again. Congress postponed approval of the fiscal year budget, almost resulting in a government shutdown. Republicans were outraged by the nearly $1.3 trillion deficit, which was the second highest in history at the time. The two parties reached an agreement on $38 billion of spending cuts, the majority of which came from programs that had not used their funding. Just a few days after that, the crisis presented itself to the world. Standard & Poor's downgraded the US's ability to repay its debt to negative. Not surprising, within 2 years, there was a 30% chance that the country's AAA S&P credit rating would be revoked. Standard & Poor were concerned that the Democrats and Republicans would be unable to agree on how to reduce the deficit. Each side planned to save $4 trillion over the next 12 years. The Bush tax cuts were set to expire at the end of 2012, according to Democrats. Congress was still debating whether or not to raise the $14 trillion debt ceiling. Many people believed that this was the most effective way to get the federal government to stop spending. The government would then have no choice but to rely solely on incoming revenue to cover ongoing costs. They would also subsequently devastate the economy. Millions of seniors, for example, would lose their Social Security benefits, and that would result in absolute pandemonium for the economy. They were afraid that the boomer pensions would go bust. The Treasury Department may eventually default on its interest payments, which would result in a debt default. Now let's be frank, it's a clumsy way to circumvent the traditional budgeting process. But of course, the US being the dominant economy in the world, the demand for treasuries remained strong throughout 2011, but interest rates began to fall and fell to 200-year lows by 2012. Standard & Poor's downgraded the US's credit rating from AAA to AA+. The stock market crashed as a result of this action. As a consequence of passing the Budget Control Act of 2011, Congress raised the debt ceiling to a massive $16.7 trillion. Some government programs were threatened to be cut to try and reduce federal spending by 10% by the year 2021. If a congressional supercommittee could come up with a plan to reduce the debt by $1.5 trillion, the drastic cut would be avoided. And as you can guess, that never really happened. As a result, the debt crisis just kept on creeping forward. Throughout the 2012 presidential campaign, the debt crisis was front and center. Barack Obama and Mitt Romney detailed two distinct solutions for addressing America's deteriorating economic health. The stock market plummeted after the election, signaling that the country was on the verge of a fiscal cliff. The Bush tax cuts expired at that time, and spending cutbacks began. The economy was reeling in 2012 due to the uncertainty around the fiscal cliff. By rolling out the American Taxpayer Relief Act, which cemented tax cuts introduced between 2001 and 10, and extending several other forms of tax relief for up to 5 years, Congress was luckily able to prevent it. Additionally, the 2% payroll tax, which is a percentage withheld from an employee's salary and paid to a government to fund public programs, was reinstated, while more cutbacks were postponed. The fiscal cliff was avoided in 2013 thanks to the passage of a Senate measure beginning in that year. Subsequently, the Congressional Budget Office forecasted a $900 billion deficit in 2019 as the result of government expenditure and the Trump administration's 2017 tax cuts. Due to the pandemic in 2020, their estimates grew even more dire. Now, new forecasts indicate that between 2021 and 2030, real US GDP is expected to rise at a rate of about 2% a year. The CBO also forecasts a $2.3 trillion federal budget deficit in 21, down $900 billion from 2020, but still the second largest figure in 75 years of the country's history. It's been over a decade of back-to-back debt accumulation through government spending. Interest rates reached record lows, followed by a series of quantitative easing by the Federal Reserve. No matter what the reason was, it was clear that the market hasn't got a chance to self-correct due to constant stimulus. If I had to define economic stimulus, I'd compare it to intoxicants. It may be alright in moderation, but the moment you cross the line, it's an addiction and everybody gets hooked. When there is unprecedented stimulus in a country, there is a misconception in the general audience that they think they are getting wealthier by the day because their savings are increasing. But in reality, it's all a sham. These people truly believe that every time the tide turns stormy in the economy, the Federal Reserve will simply inject money back into the markets and things will be back to normal. Now, on the surface, that may seem to be effective, but this is exactly what leads to unrealistic investment expectations, corrosion of wealth, and distinctly economic bubbles. As liquidity keeps increasing in the economy, a lot of it gets transferred into the stock markets, which then results in events like the dot-com bust. And as people start pulling the plug and the fire spreads, the country finds itself in a recession. The truth is here, there are no shortcuts in business cycles. They have to run their course, and that's final. Economically, the debt situation can be solved easily, but politically, it's a mammoth challenge as every political entity, Democrats or Republicans running in the election, need to please the masses, and they have just one motive: secure a vote at all costs. Honestly, what better way to do that than to make people feel like the country is secure and progressing? To begin with, the government needs to agree to decrease spending while also raising taxes by the same amount. Although each move reduces the deficit in the same way, it has varied effects on economic development and job creation. Whatever decision is made, the US government can and should make it clear what will happen, a move that is fundamental in restoring trust. That allows businesses to put the assumptions into their operational plans, and everyone else has time to prepare. To deal with the banking crisis, the US government spent at least $5.1 trillion. That's more than a third of the annual output of the country. It also raised the existing debt of the US. Although the situation was not as terrible as the one in Iceland, it had a similar impact on the US economy. Financial markets in the US have now lost faith. As a result, the country's economy is growing at a significantly slower pace. Is it feasible that the current economic condition in the US may lead to a government collapse similar to Iceland's? Well, it's a possibility, but it is unlikely. The American economy has grown in size and resilience. Investors purchase US debt during economic downturns. US bonds continue to be the most secure investment in the world. It's literally called the risk-free return in financial jargon. The exact opposite, though, occurred in Iceland. As lenders become far more concerned, they require greater and higher yields to compensate for their risk. The greater the yields, the higher the cost of refinancing a country's sovereign debt. It can no longer afford to keep rolling over debt, and it eventually defaults. Fears among investors become self-fulfilling. The US was spared from this fate. Treasuries in the US were still in high demand, but that's because the US's debt is fully guaranteed by the strength of some of the world's most powerful economies. One of the reasons for the dollar's current strength is investor trust in the US Treasury. As we speak, the Federal Reserve and the US government have three major issues they need to deal with: inflation, the war in Ukraine, and the remnants of the pandemic. A staggering 40% of all US dollars circulating in the world have been printed in the last 2 years. If the Federal Reserve fails to address the mounting pressure of inflation, the economy is toast. Institutions and investors from the country and around the world will dump their treasury bonds, which will in turn bring the markets to their knees. On the other hand, the government needs to tread with caution. They will need additional funds in case the war in Eastern Europe takes an unexpected turn or if the world witnesses another wave of the pandemic. Despite everything though, my bet is that no matter what discussion we have here today, history will repeat itself. Any form of currency or arbitrage is a function of collective trust and volume, and there is no other commodity in the world that demonstrates this better than the dollar of the US. In the greater scheme of things, it is just another crisis. We as humans will continue to overcome calamities faster than we expect. There is light at the end of every tunnel, and this is no different. Know what is happening around you, your nation, your world, and that in turn should reflect in the decisions you make. Question everything and the answers will emerge. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio, and buy and sell alerts for all my own investments. There's a link in the description to this video's sponsor, Masterworks.io, which is a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so make sure to check it out and start protecting your portfolio from inflation today. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thanks for watching, stay stoic, until next time.